Guys, have you ever noticed how the market doesn't just move prices, it starts moving your mind too? When the market drops, fear slowly starts taking over. When the market keeps going higher, greed starts getting stronger. Sometimes you feel overconfident, like you can't lose anymore. And sometimes, one bad phase makes it feel like everything is falling apart. But here's the truth. The real problem is not market volatility. The real problem is emotional volatility. Because most traders don't lose to the chart, they lose to their own emotions. And if you never learn how to control those emotions, then even if you make money sometimes, the market will still leave you with stress, frustration and regret. So guys, in today's episode of the Daily Trading Code series, we'll talk about how to stay emotionally stable when the market becomes aggressive and unpredictable. How to build a mindset that stays calm under pressure, so no matter what the market does, your confidence stays strong and your discipline doesn't break. There are certain phases in the market where it feels like opportunities are everywhere. You open the chart and the market is already moving. Confidence starts building fast. And slowly, the trader begins to feel like, now I finally understand the market. Let's say it was the month of March. Nifty was highly volatile. Big intraday moves were coming almost every day. You caught some good trades during that phase and made solid profits. Because the market had momentum, there was movement, there were opportunities everywhere. But then the market changes. Now it's July, and the same Nifty that was once giving huge moves is now barely moving 30 to 40 points intraday. Volatility has dried up. But here's where the real problem starts. The market has changed, but your mindset hasn't. You're still trading with the same aggressive expectations. You still expect the market to run 100 points every day. So you hold for bigger targets. But the market just isn't behaving that way anymore. The trade goes slightly into profit, then suddenly reverses. And the position that was once green slowly turns red. Now when this keeps happening again and again, frustration starts building. That's when emotional trading begins. You increase your lot size. You start overtrading. You keep taking random entries. Because deep inside your mind, only one thought is running. One big trade and I'll recover everything. But the truth is, the problem is not always your strategy. Sometimes the real problem is that the market environment has changed. Opportunities are limited. Momentum is weaker. Volatility is low. But your expectations are still stuck in the old market conditions. And this is something Brett Steenbarger talks about again and again. If you keep trading with an outdated mindset without adapting to the current market behavior, then your expectations and reality will constantly clash. And in that gap, many traders slowly destroy their capital. A smart trader doesn't just read charts. A smart trader reads the personality of the market. When to be aggressive, when to stay defensive, and when patience is the best trade. That's real trading maturity. Because market volatility is real. But sometimes, the most dangerous volatility of all is emotional volatility inside the trader. Now let's look at the other side of the story. Imagine the market had been stuck in a low volatility phase for the last few weeks. Moves were small, momentum was weak, and the market was mostly moving inside a tight range. So naturally you adjusted your trading style. You started using tighter stop losses because the market wasn't making big swings anyway. And honestly, in that environment, it was working. Trades were easier to manage. Risks stayed under control. Everything felt stable. But then one day the market suddenly changes. Volatility explodes. Candles become much bigger. Moves become faster. And the market is no longer calm. Now on that same day, you take a new trade. But your stop loss is still based on the old market conditions. The market gives a small shakeout, and your position gets stopped out instantly. Then a few minutes later, the exact same trade starts moving aggressively in your original direction. And all you can do is sit there and watch. Naturally, frustration kicks in. Your mind immediately says, if my stop loss was just a little wider, I'd still be in the trade. And this is where emotional trading slowly begins. Now the trader is no longer making decisions with discipline. He's reacting to recent pain. He starts changing stop losses mid-trade, increasing position size out of frustration, taking multiple impulsive entries, just hoping the next trade will recover the missed profit. But the real problem is not the strategy. The real problem is that the market conditions have changed, while your risk model is still stuck in the old environment. What felt safe in a low volatility market can become completely ineffective in a high volatility market. And this is something most traders fail to understand. They think the market is random or unpredictable, when in reality, the market is simply changing. And the traders who survive long term are the ones who learn how to adapt their mindset, their risk, and their execution according to market volatility. Because in trading, catching the right direction is not enough. You also need to survive long enough to stay in the trade. Brett Steenbarger explains something very important. The real problem is not frustration. The real problem is failing to read the market correctly. And this is where most traders make mistakes. They try to use the same system in every market condition, but the market is never the same all the time. When volatility was low, using a tight stop loss made sense, because the market was making smaller moves. But when volatility suddenly increases, trading with that same old stop loss can become dangerous. Now everything needs adjustment. Your stop loss, your targets, your position sizing, everything has to adapt to the current market environment. And if a trader fails to adapt, a mismatch slowly begins between the strategy and the market. And that mismatch eventually creates confusion, frustration, emotional stress. That's why so many traders spend every day chasing the market, yet still never feel in control. Because they are not adapting to the market. They are only reacting to it. And a smart trader understands this. Trading is not just about following signals. It's about adjusting your entire approach based on changing market behavior. But there's another important truth here. Bad trading habits don't just damage your account. They slowly damage your mindset too. Maybe you found a great setup but entered late, or placed the stop loss badly, or managed your capital the wrong way. Yes, money gets lost, but sometimes the bigger loss is confidence. And once confidence starts breaking, something dangerous quietly begins growing inside the trader. Doubt, fear, and that constant anxiety that says, what if the next trade becomes another loss? That's why trading damage is never just financial. It becomes psychological too. And that's what makes trading so dangerous. Because trading is not a one-way street. If your psychology becomes weak, your trading becomes unstable. And when your trading keeps becoming unstable, your psychology becomes even weaker. It turns into a vicious cycle. Emotions create mistakes, and mistakes create even stronger emotions. And slowly, the trader stops losing to the market and starts losing to himself. That's why successful trading doesn't come only from learning charts. It doesn't come from endlessly collecting strategies either. Real growth begins when a trader starts working seriously on his mindset, his emotions, and his decision-making process. Because in the end, strong psychology is the foundation behind every successful trader's journey. Friends, there's one thing in trading that most people completely overlook. Every trader has a different personality. Some traders naturally enjoy taking high risks. They love putting on bigger positions, catching fast market moves and chasing momentum. That's where they feel comfortable. On the other hand, some traders prefer to play safe. They feel more confident with smaller positions, limited risk, and steady returns over time. Now the real problem begins when market volatility changes. Imagine an aggressive trader who is used to making money from big moves. But suddenly the market slows down. The moves become smaller. Profits don't come quickly anymore. What happens then? Frustration starts building. Because the trader is trying to force a big move strategy into a slow-moving market. Now look at the opposite side. A conservative trader usually likes slow and controlled trading. But suddenly the market becomes highly volatile. Big candles, fast price action, higher uncertainty. Now fear starts increasing. Because the risk level has changed completely. And this is the real challenge of trading. As market volatility changes, our emotions change with it. You'll notice this even more when moving from one market condition to another. If you simply copy-paste the same stop loss, targets and position sizing from the previous market, you'll either get stopped out too early or you'll end up taking unnecessary risk. That's why smart traders don't just study the market, they study themselves too. They understand their own personality, observe changing market conditions, and create a balance between the two. Because the real game of trading is not just about strategy. It's about matching the right strategy with the right environment and with the right personality. Friends, the moment many traders make the biggest profit of their life, they start believing they've become experts. But the truth is, sometimes that one big profit becomes the beginning of their biggest future loss. You've probably heard someone say, "Bro, I made insane money in just one trade." But the real question is, how did that profit actually happen? Many times, it's not because of some brilliant strategy. It's because of an extremely aggressive position size taken in a stock that was already highly volatile. Imagine buying 1,000 shares of a small tech company and the same 1,000 shares of a large stable company. Now maybe both positions cost almost the same, but their behavior will be completely different. The tech stock will move much faster. That means the profit can become huge, but the loss can become huge too. And this is where something dangerous begins. Emotional pressure. Because when your position size becomes bigger than your emotional capacity, even a small market move starts affecting your mind. A little profit and greed kicks in. A little loss and panic begins. And slowly the trader stops following strategy and starts making decisions based on emotions and guesswork. Honestly, this is where most big trading losses begin. Look, making a big profit is not wrong. But before taking that kind of risk, ask yourself one important question. Is this risk actually within my capacity? Because if the answer is no, then the same trade that feels exciting today can become stress, frustration, and a painful loss tomorrow. Smart trading is not just about choosing the right stock. It's about managing risk according to your personality. And to understand this better, think about a simple example. When you drive on a heavily crowded road, you naturally slow down because the risk is higher. But on an empty road, you drive more smoothly and confidently. Trading works exactly the same way. When the market is highly volatile, moving aggressively up and down, taking blindly oversized positions can become very dangerous. So what do experienced traders do in those moments? They reduce risk. They control position size. And first, they respect the market. Because they understand one important thing. Survival is more important than catching every single move. Now think about the opposite situation. What if the market is extremely slow? Volatility is low. And still, you keep chasing massive targets? Frustration will increase. Because every market condition demands a different behavior. In slow markets, smart traders focus on small but consistent profits. They take quicker entries and exits and patiently grow their capital over time. And this is the real difference between an emotional trader and a professional trader. An emotional trader uses the same approach in every market. But a professional trader adapts according to market conditions. And that adaptability is one of the biggest keys to long-term success. So friends, taking risk is necessary. But taking risk without understanding it is nothing more than gambling. More important than chasing profits is building a system that can survive for the long run. Because in the end, the traders who truly win are not the ones who only learn how to make money, but the ones who learn how to control themselves. Friends, a great trader doesn't just read charts, he learns to read himself too. That's why professional traders don't only analyze the market, they also analyze their emotions. Because many times the problem is not the strategy, the real problem is that the trader fails to recognize that the market environment has already changed. Think about it. Sometimes you suddenly start feeling frustrated for no clear reason. You get irritated easily. Every trade starts looking confusing. At that moment, don't just stare at the charts. Ask yourself one important question. Has something changed in the market that I'm failing to notice? Because the moment market volatility changes, a trader's behavior starts changing too. And the most dangerous part is, this shift happens slowly. Sometimes the market becomes extremely fast. Every candle moves aggressively. And sometimes the same market becomes so slow that for hours, there's barely any clear movement at all. But many traders keep using the exact same approach in every market condition. And that's where emotional mistakes begin. That's why smart traders don't only monitor the market, they monitor themselves too. They constantly notice things like, am I becoming overconfident? Am I becoming impatient? Am I drifting toward revenge trading? And because of this self-awareness, they slowly become their own coach. Now the question is, how do you actually do this in practical trading? Very simple. Create a few clear rules for yourself. For example, when volatility is high, how much position size will you use? When the market becomes low, how will you adjust your targets? And when your emotional state is bad, will you continue trading or step away for a while? These rules may sound simple, but over time, these small rules create emotional stability. And in trading, emotional stability is often more powerful than any strategy. Now friends, there's one more thing here that most beginners completely ignore. Trading volume. Because volume doesn't just show activity, it shows the energy of the market. Imagine a stock that normally trades around 100,000 shares by 10 a.m. every morning. But today, by the same time, only 500 shares have been traded. That's a clear sign the market is slow, participation is weak, and volatility will probably remain low. So what do experienced traders do in this situation? They keep smaller targets, they book profits faster, and they avoid unnecessary risk because they understand one thing. You cannot force big moves out of a slow market. Now think about the opposite situation. What if the same stock has already traded 200,000 shares by 10 a.m.? That means the market is unusually active. Now volatility can expand, price can move aggressively, and larger players may already be participating. In those moments, smart traders give the trade more breathing room. They adjust stop losses according to market structure, so normal volatility doesn't throw them out too early. And this adaptability is one of the biggest signs of a professional trader. Because the market is always changing. Sometimes fast, sometimes slow, sometimes emotional, and sometimes completely dead. But the traders who stay profitable are the ones who learn how to adapt in every condition. So friends, reading charts alone is not enough. Learn to read your emotions, understand your behavior, observe volume carefully, and tune your strategy according to the personality of the market. Because in the end, the traders who survive are not the ones trying to control the market, but the ones who learn how to control themselves. Friends, success in trading doesn't come only from taking the right entry, it comes from learning how to control yourself in every market condition. The moment a trader starts understanding not just the market, but also his own emotions, that's when real growth truly begins. Because long-term money is not built through excitement, it's built through discipline, patience, and adaptability. So the next time you take a trade, don't just look at the chart. Observe yourself too. Because that one level of awareness can transform you from an emotional trader into a consistently profitable trader. If you learned something valuable from today's video, make sure to hit the like button, subscribe to the channel, and don't forget to press the bell icon so you continue getting practical trading psychology videos like this. I'll see you in the next video. Until then, keep learning, stay disciplined, and keep trading smart.